Hey, folks, thanks for tuning in to our MMG weekly recap. So, up on the screen, I have the 10-year note yield, and there's an important, very, very important technical development taking place in the 10-year note yield. And it meets the macro story or the fundamental story, probably one of the more important Fed meetings, which is going to happen next week. So, let's talk about where we are now technically on the 10-year note. So, you can see here this blue line, let's call it 350. The peaks in June, the highest interest rate of the year for a 10-year note was 349.80. You could see really clearly we touched it a couple times, and then a nice pullback in yields emerged. We went all the way back down, ultimately to 250, and then over the last 6 weeks, we went from 250 to 350. And look at what happened today on a Friday. We went right up near this ceiling, and we came back lower. So this is a big deal because the way technical analysis works, resistance becomes support and vice versa. So this is a ceiling. This is resistance. This is preventing yields from going higher. If the 10-year note yield moves above this ceiling, 350 will go from being as bad as things can get right now to being potentially as good as things can get. So it's real important that we follow this chart. Now, next week, the Fed's going to raise rates, 75 basis points. We're seeing two interest rate moves. The 2-year note, which front runs what the Fed is doing, is exploding higher. It's at 390. The 10-year note is stalling under 350. So now you have this wide yield curve inversion. You're hearing a lot about that on TV. Well, it's probably going to get a lot wider because besides the inflation component, which the Fed is looking to fight with, there's the recessionary component of will the Fed overdo this? And the bond market is starting to say, the Treasury market is starting to say, we're going too far because we can't afford otherwise. And so it's a real battle that we have to watch. We have to follow these things very carefully. But the one thing that we know about a recession, and we know one thing we know about a deep yield curve, and it goes back 50 plus years. Anytime we've had steep or deep yield curve inversions where the 2 and the 10 get very wide, it's always followed by rate cuts. Now, we don't see a rate cut happening yet. We think what's going to happen is the yield curve is going to get wider still because the Fed's going to still hike a few times, and the 10-year note's going to buck the trend. Let's hope that the 10-year note fights and holds its ground right here, because this would give us a chance for long-term rates to kind of flatten out and give us some sanity. If we break above it, all bets are off. Of course, hey, folks, if you need Mortgage Market Guide or something like this in your corner each and every week, click the link and sign up. We appreciate you. Have a great day and a terrific weekend. We'll talk to you soon. Bye for now.